Welcome to Truth in Accounting's Ask the Experts webinar. Thanks to the Union League Club of Chicago for co-sponsoring today's event. Our topic today is Social Security and the debt limit, the federal debt limit. I'm feeling guilty using the word limit, but we'll talk about that. The new Social Security Trustees report came out in late August. And on a related note, Congress just approved an extension of the federal debt limit until December. My name's Bill Bergman. I'm the Director of Research for Truth in Accounting. We're a nonprofit dedicated to helping citizens understand government finance with a view to promoting truthful financial reporting by our federal, state, and local governments. You can learn more about us at our website at Truth in Accounting, where you can also sign up for our morning call newsletter, which compiles government financial news every day. We also offer our Data Z website, where you can create charts comparing cities and states and the federal government on a wide range of financial and economic factors. We're honored today to have Chuck Chokel join us. Chuck is a board member of Truth in Accounting, and for over 30 years, he's worked in the insurance industry, a great frame of reference for understanding government finance. Chuck spent much of his career at Progressive Corp, rounding out his tenure there as Co-CEO and Chief Investment and Capital Officer while serving on the board of directors. Joining Chuck and me today is Truth in Accounting's founder and CEO, Sheila Weinberg. Sheila's a CPA and has led Truth in Accounting's initiatives since 2002. Her commentary on the federal budget and state and local government finances has appeared in numerous publications, including USA Today, the Washington Post, and the Wall Street Journal. For today's event, everybody's going to have a chance, and go ahead and take a look at the Q&A feature at the bottom of your Zoom menu. If you hover it over your mouse over the bottom, you'll see a panel with Q&A. Just type your question in that box at any point during the event, and we'll try to answer it. I'm going to turn it over to Sheila and then Chuck for comments, and then we'll get to questions. Sheila?
Thanks, Bill, and thanks, Chuck, for joining us. I'll just be brief so we can get to Chuck's comments. As Bill mentioned, the House and the Senate have both approved an increase in the debt ceiling and they anticipate that will last until December. This increase in the debt ceiling, you have to kind of equate it to, whether, when you hit your credit limit on your credit card, would it be nice to just be able to go, well, I just want some more debt, an increase in my debt limit. And that's what Congress does. They have the authority to say, well, okay, we're only going to spend this much, borrow this much money, but at any time they can just go ahead and increase that. We have, believe it or not, already reached the debt ceiling, but the Treasury Department has taken some, quote, extraordinary measures to keep it artificially from not reaching that. Technically, we haven't reached it, but we really have. These extraordinary measures include suspending issuing Treasury securities to state and local governments. They actually redeemed some securities that from the Civil Service Retirement and Disability Fund, and they just stopped investing in treasuries. They stopped issuing treasuries to other parts of the government, like the Employees Retirement Thrift Savings Fund. But once Biden signs the legislation, then these extraordinary measures need to be unwound. And last time we ran into this was in 2017. Once the legislation was passed and signed into law, in one day the national debt went up by $318 billion. That's with a B, in one day, because they had to pay back all these things that they had kept done to keep it artificially low. During the debate about the debt ceiling, people highlight that reforming Social Security and Medicare should not be part of the discussion, because the debt does not include the money of the unfunded promises to Social Security and Medicare. It only includes the money that the general fund of the government has taken from the trust funds, and that's the only amount that's included. We have the Social Security debt that's not included. These are promises that have been made to people, and I think they're counting on them. At least some people are. The unfunded Social Security Medicare promises are $41 trillion, and the Medicare is $55 trillion. So even though they're reporting the national debt to be $28.5 trillion, and that again, that will increase by hundreds of billions of dollars once this bill is signed, we calculate the national debt is really more than $139 trillion. But to give you an idea of why Social Security should be included in the debt ceiling, and the reform should be included in the debates, I'm going to turn it over to Chuck to review how some of these near-term promises and long-term promises, how much those really are. Thank you, Chuck, again for joining us.
My pleasure, Sheila. Thanks for having me. So we'll start by pulling up the cover sheet of the August 31 report, which was issued 6 weeks ago by the Social Security Administration. In summary, Social Security collects payroll taxes from about 176 million covered workers who last year paid in about $1.1 trillion. The money was paid out to 65 million beneficiaries of Social Security and the Disability Income Trust Fund, also in an amount of roughly $1.1 trillion. So it was pretty balanced, money coming in, money going out last year. There are currently 2.7 workers for every beneficiary in the program. And you should know this program is administered by over 60,000 federal employees at a cost of about $6.3 billion per year to run the department. As you can see in the signature page you're looking at, needs to be blown up a little larger there, Courtney. You've got the 4 acting trustees. 3 of them are the Secretary of Treasury, Labor, and Health and Human Services. And then we have the acting commissioner of Social Security, who was basically appointed on July 29th this year, so was only in her position for 1 month before this report came out. And Scott Frey, who was appointed in January of this year, thus had about 7 months in the job before this report came out. I should note that I don't know much about either the acting commissioner or the chief of staff of Social Security. However, I do know neither has managed or has experience in managing an organization as large as the 60,000 plus Social Security employees. You'll also notice on the signature page, there's 2 vacant public trustees. Congress, some time ago, 6 years ago or so, said we should have some citizens on this committee, on trustees, since they're the ones retiring and collecting paying the funds and receiving the funds. And yet the parties have not nominated or put in place any public trustee in the last 6 years. These positions are vacant. So in summary, the report's headline, I'll give you the headline and then we'll go into some detail. The headline of the report is that Social Security Trust Fund will be depleted by 2034 versus 2035 in last year's annual report. But my conclusion from reading the report is this is not the most important finding, as I will talk about soon. So going to the next page, again, we need to make this a little larger. The report is 276 pages, and this page highlights the key assumptions for the long-range projection period, 75 years. And most of these assumptions are from periods 2030 or 2031 through 2095. So basically, the authors of this report put assumptions in 2 groups. Short-term assumptions are basically those in the next 10 years, and long-term assumptions are the ones in the 65 years thereafter. There are 11 categories of key assumptions. 3 are demographic, as you see there. Those are the birth rate, the death rate, and the immigration rate in the United States. The 6 economic variables are the productivity, the average wages paid, the consumer price index, the average real annual wage, the unemployment rate, and the trust fund real interest rate. And then 2 programmatic assumptions are the disability incident rate and the disability recovery rate. Of these 11 categories, there were really only 2 that changed of any significance since last year. One was the average fertility rate, where it's now 1.99 children per female adult, whereas last year it was 1.95. And there are a lot of reasons that impact fertility rate, most of which have driven fertility down in the recent years. But for reasons I can't fully explain, fertility was assumed to rebound back up to historical norms and not stay down. The other assumption that really changed was the annual trust fund real interest rate. The unemployment rate. The unemployment rate was assumed at 4.5%. This year, it was 5.0 last year. And these, again, are assumptions about a 65-year period. So the trustees are saying they think the unemployment rate is going to stay down for decades. There wasn't really a table for the short-term assumptions, but I can talk about a couple of them that caught my attention. One was the death rate for adults or people over 15 years old. The death rate was assumed to be up 16% in 2020 and 15% in 2021 over prior years because of COVID, and then normalized thereafter. Another important change was the real interest rates, which short-term are at 0, but in actual terms are assumed negative for the next 3-4 years. In other words, the rate of inflation will be higher than the interest rate that the trust fund is going to earn on its bonds. Lastly, I'll just mention we had the reality that we had a big recession in 2020. There were nearly 20 million Americans who lost their jobs. And as we sit here today, we're still down about 4 million from the peak before COVID. So the fact that short-term interest rates are a lot lower than expected, and we had a lot of unemployment in the short term, impacted the long-range results of Social Security. So turning to the next page, you take these assumptions, and this is the conclusion that, and I go to the column OASDI intermediate. So basically there are an intermediate case, which is the best guess case, and we'll focus on that primarily. And OASDI is the Old Age Survivors Trust Fund plus the Disability Insurance Trust Fund. So it's, in other words, the total of the two. So last year, this number was 261% for 2020. And now for 2021, that total is 253%. That means in the trust funds now are 253% of the annual payout. So we have plenty of reserves, but you can see how that reserve level falls year after year after year until it gets down to 85% funded. And then if you go all the way to the bottom of that column, after all the B's, you get 2034. And that's what this report says, that the trust fund reserves will be permanently depleted in 2034. There'll be no more money unless something changes. And you can see that just to the left of that, that if they were standalone programs, the old age survivors insurance would be depleted in 2033, and the disability insurance would be depleted in 2057. The combination of the two is 2034, because obviously the old age survivor insurance program is much, much bigger than the disability insurance program and has a heavier weight. I want to point out one other number over to the right side of this. Follow that 2034 over to 2031 in the far right. So this is basically the trustees saying, in a worst case scenario, these trust funds are going to run out of money in 2031 or in 10 years. Finally, going to the bottom of this page, we'll scroll down here. Now you got to scroll up a little bit more. There we go. In 2034, there's a 78. We'll circle that. That basically says the benefits as a percent of scheduled benefits, there'll be enough reserves to pay 78% of the benefits in 2034, a 22% shortfall. So this is on page 69, and the trustees' conclusion is we're going to run out of money 1 year sooner than last year. And I asked myself, does the depletion rate of these trust funds really matter? And my conclusion is not so much. And the reason I conclude that is on the next page. So Courtney, pull up the next page, please.
She might be having, oh, there she goes.
Here it is. So basically, this is a chart put out by the Treasury Department showing the flow of money the government takes in and pays out. So the lower left-hand box shows payroll taxes. Those are Social Security payroll taxes, and they go into a box containing the OASDI trust fund accounts and the hospital insurance account. But you'll see that the government commingles all its money in the middle there, other government accounts. They borrow money from the trust funds, they credit interest to the trust fund, and then they send some benefit taxes on Social Security benefit payments back to the trust fund. So my main point here is all the money is getting commingled before it gets paid out. That's why I don't know that just having the trust funds go to zero is very meaningful if the government can print money and pay it to any of the boxes it wants to pay it to. So I think that is likely what would happen if the trust funds got to zero. The government would simply print more money and credit the various trust fund accounts, in my opinion. The next page, this is page 209 of the report. Well, stay at the top, please. So I think this is the most important page of the entire report, and I find it ironic that it falls on page 209. You have to read a long way in to get to this. So basically, this is the longer range assumption of how unfunded the Social Security programs will be through 2095 and through an infinite horizon. So we'll start with the through 2095. The value will be 19.8 trillion short by that year, projected in this report. Now, last year, that number was 19.7. So that's pretty good. We didn't get much worse, only $100 billion. But the more important problem is that you read down a little bit at the bottom here, you see it says last year trustees projected that the infinite horizon unfunded obligation was 53 trillion. So maybe go down in the text, circle that 53 trillion. There you go. Circle that and draw a line up to the 59.8 trillion. So in last year's report, the government said on a infinite horizon, we're 53 trillion short. And now in this year's report, we're 59.8 trillion short. Well, that's a difference of $6.8 trillion in 1 year. So what makes up that $6.8 trillion? Two things right there in the text. The first one is 1.4 trillion. And all that is rolling the assumptions forward 1 year. In other words, by including 2095 in the 75-year horizon, 2095 is going to be a horrific year if nothing changes. Things are going to be 1.4 trillion worse just by including that year. The 5.4 trillion, that is the balance of the worsening. You see that in the text. Circle that, Courtney. There we go. That is due to other real assumptions, particularly that the near-term interest rates are going to be low. In fact, the real interest rates are actually negative for, as I mentioned, from 2021 through 2024, because inflation is going to be higher than the interest rates earned on the trust funds. So that's the bulk of the problem. So we are 6.8 trillion worse in 1 year's time. That is really bad. And I need to take a minute to explain the trust fund that Social Security looks at a 75-year horizon. That's pretty much the horizon that pays out everybody who's currently alive and earning under Social Security today. The infinite horizon, but what happens at the end of 75 years is their assumption truncates so that the next two generations that pay in to Social Security and disability funds, at the end of 2095, it just stops. So the benefits owed those same two next generations are not included in the 75-year look. So I maintain that 75-year look is just very artificial, and that it's really the net present value of the infinite horizon that is the most important, because that's the one that's truthfully saying how much is expected to come in and be paid out, and then net present value those annual assumptions. And that result is a negative unfunded 59.8 trillion. Now I want to highlight something. This is on page 209 of this report. These numbers, the 59.8 trillion, is not included in the summary. The conclusion summary, if you were to go back to the beginning of the report and read the summary and read the conclusion, you would not find this number, nor would you find the 19.8 trillion, which is the 75-year look. Instead, you would find out what I said earlier, that their headline is, we're going to run out of money by 2034. Yes, we are, but there's a lot bigger liability growing that remains hidden until you read to page 209 of this report. So,
And Chuck, I didn't see these numbers mentioned anywhere in the press at all.
they don't. The media does not pick this up. They simply take the conclusion put out by the press release, which is trust fund's going to run out of money in 2034. That's the story, and very few citizens read this far, and very, very few media cover the really important numbers in the back. So now I want to take a couple minutes to just comment on how hard it is to run Social Security. I think it's a difficult thing to be paying out 65 million people and working with 60,000 employees. So going to the next page, Courtney. Scroll a little, there you go. So the government recently has required all its departments to publish their improper payments. In other words, admit errors. Now, from the Social Security website, I read, quote, We consider payments improper if they result from our mistake in computing the payment, our failure to obtain or act on available information affecting the payment, a beneficiary's failure to report an event, or a beneficiary's incorrect report. So some of these improper payments are Social Security mistakes, and some are beneficiaries' false reporting, if you will. Surprise, surprise, an estimated 80% of the amounts of money are overpayments to people, not underpayments. And the obvious answer, if you're underpaid, you call up and complain and get it corrected. And if you're overpaid, you don't. I did just today look at the 2020 results, and they're pretty similar. That the old age survivor and disability insurance had 2.579 billion of improper payments in 2020, down very slightly, under 1% from the prior year. But you can see it is down from 6.2 billion back in 2018, which was really a year full of issues. I also pulled up, I went to the Inspector General reports. I said, let me read a few Office of Inspector General reports covering audits of Social Security, and I came across two that I thought were interesting. The first one was done in June of 2021, published, and the Office of Inspector General says Social Security issued approximately 79 million in payments after the death of 1,127 beneficiaries. In other words, an average of about 70,000 each. So this was up from a sample of just 3 states. They pulled Alabama, Georgia, and Illinois, and they looked at the electronic death registration, and they found that Social Security kept paying $79 million to 1,127 deceased people in these 3 states. And when you ask, well, why did that happen? Well, it's partly because Social Security rejects EDR, electronic death registration reports, that do not pass its formatting and identification tests. So, it's tough to be accurate, but the cost of inaccuracy is huge. Furthermore, this same report identified in just these 3 states 53,486 non-beneficiaries who were deceased and yet did not show up on whose death information was not in Social Security's database. So that's the potential for overpaying or 53 or 54,000 people because you weren't matching up the death records correctly. This is a big problem and very costly, and Social Security has improved. They are working on it, but it remains a problem as stated in the June 2021 audit.
Yeah, and Chuck, just to give people an idea of those numbers, comparing it to other agencies in the government, the Environmental Protection Agency, the EPA, its total money that it spent was $8.7 billion, and these improper payments are close to that at $8.1 billion. It's more than we provided money to the National Science Foundation. We gave them $7.3 billion. These missed payments are higher than we gave to them, more money than we gave to the New York Nuclear Regulatory Commission and the Securities Exchange. So these are large numbers of just improper payments.
I want to make another comment. I believe there are over 6 million Social Security beneficiaries who are over 112 years old. That is impossible. That is not true. And the Social Security Administration puts out this 276-page report. And what I would like to see is a table of actual age. How many 100-year-olds, how many 101s, how many 102s, how many 103s are collecting benefits? Because if you saw the actual numbers, people will begin to ask, well, how the hell is somebody 135 years old still getting benefits? And that is a table that should be disclosed to the public. It never has been. If you ask for it, you're not going to get it. But I just, in this public forum, ask again, publish the data. There's nothing, there's no privacy concern. You're not telling us what names there are. Just tell us the distribution of age of the people collecting Social Security. Because what happens when somebody dies, if they aren't in the death record and it doesn't get, they'll just keep sending money to a bank account. And whoever's collecting that bank account is going to just let it run for decades. So here's one last audit done by the Inspector General. This was a match of death records for Medicare and Medicaid versus the death information in Social Security. And they checked 78 million records, which is a huge number. And they found 3,084 current beneficiaries identified in the Medicare database as deceased, currently getting paid by Social Security. And Social Security had issued these people $125 million. So if we could just get the two government agencies to talk to each other and share death records, we would save $125 million. So it's a difficult thing to get that many records correct, and there's a lot of reasons, but it's a lot of money, and I would spend it on trying to fix these things, as I hope they are.
Chuck, if you were the CEO of an insurance company that had this kind of record for improper payments, what would the shareholders and board of directors think?
They would think you're incompetent for not addressing this size fraud or inaccuracies. And this has been an inaccuracy that's gone on for over a decade. I don't mean to highlight that the current administrators who have only been in their roles a very short time, but it's been around for so long that it's just not a priority of government. So with that, I'll end and I'll let you ask your questions.
Sounds good. Chuck, what do you think the possible inflationary implications are of the current condition of our federal government in general and Social Security specifically?
Well, I think that Social Security will raise taxes a little bit, cut benefits a little bit, extend qualifying age a little bit, but in the main resolution is going to be print money. It is the only resolution that can come anywhere close to raising $59 trillion, because you have to cut benefits 30% to kind of get a third of the way there. And if you cut benefits 30%, no politician would ever get reelected, so they're not going to do that. But printing money, they will, not get kicked out of office.
So these numbers represent trillions of dollars of that they don't have a plan on where, when we say unfunded liability, they don't have a plan on how they've promised these benefits. Unfortunately, some people are counting on these benefits and they have no plan on how to fund them.
Or they have a plan, but they're not going to say it. The plan is we're going to print money and send it to people, and they're going to get paid in full and everyone will be happy. That's our plan. But you can't say that.
Won't that increase, if you print money, that, correct me if I'm wrong, Bill, I'm not an economist, but doesn't that increase inflation? And so therefore, even though people are getting these benefits, they're worth less. And then also, doesn't it get into a vicious cycle of where the Social Security and Medicare benefits are based upon numbers that are affected by inflation? So then you're just in a vicious cycle of never being able to catch up.
Right. As you saw today, it was press released that the Social Security Cost of Living Index for 2022 will be 5.9% higher than 2021. So there's inflation. I mean, they're picking it up. They're going to raise the benefits nearly 6% in 1 year. And they're going to have to do that a lot in the future.
And
Well,
so
our
then
Congress
that increases the benefits, and then you have to borrow money to pay those benefits, and it just seems like a vicious cycle that it's not going to end pretty.
Just a reminder to the audience, the Q&A thing is open. Jump in if you want and ask questions and join the conversation. I have a follow-up on that idea. Our Congress has created Social Security, and the president has signed that law. But we also have a law that created the Federal Reserve, and a law in the Federal Reserve Act calling for the Federal Reserve to pursue stable prices. So are we coming to a place where we're between a rock and a hard place? What the Federal Reserve, how can it pursue stable prices if the government is going to be effectively printing money to deal with the size of this problem?
Well, the answer is inflation is relative to other major economies in the world. So if the United States is inflating, but so too is China, Europe, Japan, and England, UK, then relative inflation is not disproportional. Things will cost more, but capital won't flow from one country to another, and they'll still be able to borrow at whatever rates they set, because capital won't be able to go to an alternate source.
Well, we've had Social Security get in trouble before. What happened then? And is it possible we're going to see a change like that in the future?
Well, I went back, and this report has a table on that. Social Security trust fund ratio, the reserves to annual payout, got down to 14%, which was the lowest in its history in 1983. And what happened? Three things. They began taxing benefits. And today, taxing Social Security payments brings in $40 billion to the government. You know, in the old days, they didn't tax Social Security benefits. Second, they raised the wage limits and also raised the tax rate. And those tax increases were up 542% over the last 37 years. But surprise, surprise, benefits were up 557% over those same 37 years. So they put their finger in the dike, they held off the flood, but it's still leaking.
Yeah, and the people who, you talk about increasing the taxes, there are a lot of lower wage earners who are paying more in Social Security taxes than they're paying in income taxes. And the assumption, I think, by those workers is that, well, I'm paying these taxes, but I'm really not. They don't even think of them as taxes. They think of them as contributions. But some of these people, so they're contributing into this plan, but what we're saying is, they're not going to have enough money to pay these benefits. They don't have, except for inflating it. They don't have a plan to pay. So these low income workers are paying these taxes. They're not contributing into Social Security, and they're not guaranteed these benefits.
Well, along the lines of the question about taxing Social Security benefits, a related question in light of Chuck's fascinating chart showing the commingling of money is the following. Do all Social Security taxes sit in the Social Security Trust Fund?
Well, direct payroll taxes go exclusively to the Social Security Trust Fund, they then get borrowed out, but they do go through the trust fund. However, the federal government's taxation of Social Security benefits, some of that money flows to Social Security Trust Fund, but some of the money flows to the hospital insurance fund and or Medicare. So it moves around. They have various categories of excess taxation as the government deems it and sends the money in different directions. And I guess the government says, hey, look, if we're going to tax Social Security benefits, we're entitled to send the money we get wherever we want.
Well, thinking about the inflationary implications once again, what do you think about the assumptions for inflation in the trustees' report itself compared to your own expectations? Are they lowballing future inflation? Is the problem even worse than what we're being told?
Well, they're assuming a consumer price annual inflation of 2.4% per year for the next 75 years. I think once you say, how the heck do you pay 60 trillion? And by the way, Medicare is even worse in terms of being underfunded by a bigger number. Whenever they begin to pay those enormous balances, the consumer price index has to be higher than 2.4%. But I would also mention that, as I've said in past talks, the consumer price index is not accurately measured, particularly in housing. And I could go on a long talk about the inaccuracy of the CPI, but I'm not, that's not for this discussion.
Well, going back to the trust funds, and you're saying that the other funds are, they're being borrowed by other funds. So, I think that people, think why are trust funds called trust funds? It's just because Congress decided to call them that.
Well, I think they're called trust funds because in the beginning, that money was held in trust, and it was only for Social Security, and it was not going to be commingled. And then after decades of being in existence, government ran short in some accounts and said, well, we'll borrow from over here, and began to commingle. So they stuck with the original nomenclature when originally it was a true trust fund.
Yeah, in the 2016 audit financial statement of the federal government, it said that in the federal budget, the term, quote, trust fund means only that the law requires a particular fund to be accounted for separately, used only for a specific purpose, and designated as a trust fund. A change in law may change the future receipts and the terms under which the fund's resources are spent. In the private sector, the trust fund refers to funds of one party held and managed by a second party, the trustee, in a fiduciary responsibility. So, the government's, the Treasury Department has indicated, that trust funds in the government is not, the government doesn't hold this money in trust for people.
Should they change the name? Should they stop calling it a trust fund?
Well, I think it totally, I think it's one of the many things, like our term surpluses, many terms that governments use that I think confuse and mislead people, because, even, the discussion, them saying, well, the trust fund solvency, it's going to run out in less than a year. And as Chuck mentioned, they focused on that. The Office of Management and Budget has said, and I quote, in the public discussion, solvency means the trust funds, keeping the trust funds from exhausting their balances and ensuring the ability of the funds to finance promised benefits. Defined that way, trust fund solvency is not a meaningful measure of the government's ability to meet its future obligations. So just because they have this accounting mechanism and the balance in that account is positive, doesn't mean that the government has any money to pay those benefits.
Well, along the lines of, we have a good audience question related to demographic issues. So I'm going to ask the following question before we ask the audience question. The projections that Chuck was addressing in these reports are driven by expectations for future demographic trends under current law and policy. If you had to project future changes in law and policy, what lies ahead for us? Are we going to get benefit reductions or tax increases or both or neither? What lies ahead?
My opinion or guess is that you'll get about 10% tax increases. You'll get about 10% benefit reductions and extension of age qualifications, and you'll get 80% paid by printing money. That's my guess.
That's a little scary. So I'll ask another scary question from the audience. An anonymous attendee asks the following. I'm 32 years old. Very simply, will I get Social Security when I retire?
I think the answer is yes. You'll be paid in full, despite the fact it's going to be 30 years before you collect. But how much those dollars are going to be worth 30 years from now, that's going to be the bigger issue.
And how much everybody's dollars on everything. So you might get, what you're saying is you're going to get a benefit, but that how much bread is going to be very inflated. You know, house electricity is going to be very inflated, and those dollars will not go as, you know, will not meet the needs of a retired person.
I think that's going to be accurate. You're not going to be able to retire on the benefits you get.
Social Security may not have as much security in the future as it has had in the past, perhaps. I'm going to ask a related question to, you know, how do we think about the federal government's credit rating? And in turn, you know, what does your outlook for Social Security and or Medicare imply about where a credit rating should be for the United States government?
Again, I think credit ratings are relative to other developed countries. They're not on an absolute scale, they're on a relative scale. So if you've got these same problems of unfunded liabilities in China, more in Europe, and more in Japan. Japan has a much worse unfunded liability than we do. So those other areas are more likely to blow up first and see their currencies depreciate against the dollar. And then you'll see the dollar depreciate against other real things that are not fiat currency.
These are dark and foreboding outlooks, I'm afraid. Is it possible that push will come to shove and we'll actually see some energy in our government to address the issues concretely, or is this a foregone conclusion?
I think it's a foregone conclusion, because imagine what politician would sponsor, we need to cut benefits 30% immediately and permanently. Now, who would run on that platform, and how many votes would they get?
Would they run on that? Will it take a crisis to solve the problem, or do you think it's going to be?
There won't be a crisis. It's printing money doesn't create a crisis overnight. It's the water boiling slowly while you're the toad swimming in the pot. You don't, it's just every day, a little bit at a time. And then one day you figure you're in trouble.
And I also think, you know, inflation and all these issues affect, again, I think of the lower lower, you know, income, like we're going into right now, we're going into, you know, an inflationary period. Some people say it's temporary. And, you know, for example, you know, housing, heating fuel costs are going to go up. Gasoline's going to go up. And so, you know, the lower income people who that's a higher percentage of their budgets, it's going to cause havoc to their budgets. And this, you know, in printing this money and causing this inflation in the future, even though it's slower, I think it's actually, it may be slower at the very, very, very slow at the top income earners, But at the lower income earners, it affects them, I think, faster and at more intensity.
I also want to go back to your question about, do I think government or politicians will address the issues? They first have to put the numbers that sit on page 209 on the first page of the report. Until they do that, the media is never even going to find it, and the public's not even going to talk about it. And maybe there's a reason they don't want anyone to find it or talk about it, because they don't have an answer, and it's a scary proposition to talk about it.
Well, we have a statement from an audience member that is more of a statement, but I'd like your reactions to it. Somehow it sounds like we need to put Social Security taxes into a bucket and not use it for other things. People think we are out of money, but it's not really true. Is that one thing that government could do to change the system? Could we sequester or isolate money in Social Security and address the issue that way?
Okay, so which programs will get defunded therefore?
That's the implication.
Well, go ahead.
There's certain parties that say, okay, let's not have any defense spending. And that would, if we took all our defense money and put it all into retirement programs, that would give us a couple more decades of leeway. Well, what are the implications of that?
Yeah, the other thing that happens when you put this in another bucket is like right now, Social Security and other trust funds, including Medicaid, Medicare, the balance is more than $6 trillion. So let's say that, the money that they borrowed from that should be in the trust funds right now is $6 trillion. Where would we want the government? The government's not going to put that in a mattress. Then does the government become a huge investor in what different, where do we put that money? I don't know what you do with that money.
Now, there have been proposals to not invest in treasuries, but to have the trust funds put it into index funds for equity. And over any 10, 20, 30 year period, maybe any 20, 30, 40 year period, equities will way outperform bonds. And I think that's true today. I think equities, although they're at high price valuations, long-term bonds are at very high price valuations. So if it were self-directed, at least people would have a chance to control their own destiny more than they do today.
Interesting, self-directed.
Yeah, but the issue with that is that we're in this almost like Ponzi scheme. So you were saying earlier that there's $1 trillion worth of taxes going into the system right now and $1 trillion of benefits going out. Well, if you said to the people, well, we're not going to charge you Social Security taxes anymore. We're going to let you keep that money. So they're keeping $1 trillion. And then, well, then where do we get the money to pay the $1 trillion of benefits going out?
We print it.
Well, we have a follow-up question from the same person that asked an earlier question along the printing money idea, and that's the following. Is the reason we can print money without degrading the value of the money because other countries use the dollar as a reserve currency? Printing money certainly didn't work in Venezuela or Argentina. Is that the same issue in the United States if other countries are using the dollar as a reserve currency?
The answer is yes. Being a reserve currency has a lot of advantages. That's a big one. But don't think that these other countries aren't also printing their currencies in huge quantities and huge quantitative easing. Europe's done far more than we have relative to GDP. So there, Europe, Japan, others are going to go down before we are. But our numbers are much, much bigger.
It doesn't speak well for the international environment if we look good compared to others on this score, I'm afraid.
Well, I think that's why, during this current crisis, the government just had a hose of money that they were spreading around to the economy to try to rescue things. And a lot of that money was borrowed. And if we couldn't borrow that money, what would we do? The reason that we can borrow that money is because the US is in better shape than other countries. This is like the safest place to invest. As you say, it doesn't speak well to other countries or other investments if we're the safest place.
And yet maybe that reserve currency shouldn't be taken for granted. Maybe it's there today, but there's a quote about bankruptcy. How did you get bankrupt? And the answer is very slowly, but then all of a sudden. Is that something that might be in our future, Chuck? What do you think?
Possibly.
Well, that's what I think Chuck is talking about with this slow boil, that's the very slow boil. And I think that what we have to think about is two things. One, I've spoken to people who were in Argentina and an Eastern European country who did in essence go bankrupt. And they did say, there were problems, and some people, like you at Truth in Accounting, were highlighting them. Like you're doing in the US, but people didn't pay attention. And then overnight, we just hit the wall. And we do have an experience of that where, again, think back to the housing market crisis. There, everything was going fine. Housing prices were going up. People were investing in housing. People said houses values will never go down, never. And then overnight, crisis happened. And I just get nervous that, yeah, we may be in a very long, slow boil, but when the crisis happens,
when the frog jumps out, it jumps out fast, or maybe that's the.
Yeah, and again, maybe some of the wealthier people can handle the crisis better, but the lower income or not, the 90% of the population, they're not going to be able to handle that crisis.
Well, we have a last final audience question that isn't necessarily Truth in Accounting territory, but we're going to ask it anyway. In light of this dire forecast, very broadly, what investment strategies would you recommend for listeners?
We should probably do the disclaimer that we're not giving investment advice, but others have said allocate some into other assets that are real assets. And a real asset might be real estate, it might be Bitcoin, it might be gold, it might be anything but fiat currency that is being printed and inflating year after year after year.
One thing that I've become more energized listening to both of you is the intensity of the predicament that we're in. Hopefully we can energize other people in America to care about this in a way that we don't have that day of reckoning down the road. Any final thoughts from either of you?
The intensity is not meant by our perception. I think the intensity is driven by how large the numbers reported by the government and shown on page 209. I mean, it's a combination of the government's hiding this by putting it on page 209 and not including it in the summary. And the number is huge, growing 6.8 trillion in a single year, and no one even mentions that.
And the government doesn't include Social Security unfunded obligations on its balance sheet. Sheila, is that an issue?
Yeah, the unsecurity of these, is highlighted by the fact that the government doesn't show them as liabilities on their balance sheet. The government believes, and the reason they don't is because Congress can change the law at any point in time. So if, let's just say we have a generational warfare and we get enough voters to say we're going to cut these benefits, Congress believes that, tomorrow, not even years from now, they don't record any liability because tomorrow they could cut the benefits at any point in time. And I have to highlight our data-z.org website. There is a federal page there that shows the overall financial condition of the government. And plus you can create federal charts that show you the ever increasing Social Security and Medicare and other liabilities information. So I would direct viewers to that. But the more I'm so glad that Chuck was able to give us more detailed information than then the headline that, hey, that we're doing, it's not bad. The trust funds are going to last for, more than another decade. We seem to be okay. It might have gotten short one more year, but we have at least a decade that this money will exist. But to show the true facts is very important.
Well, we'd like to thank all the viewers for joining us, and Chuck especially for joining us at Truth in Accounting. We thank you for your leadership at Truth in Accounting, Chuck, too. And we'll see you all again in our next webinar. Have a nice weekend.
Our pleasure.